Hello and welcome to a continuation of our discussion on accounts receivable. This video will discuss what is done for accounts receivable when they are not collected. After viewing this video, you should be able to describe the four transactions related to accounts receivable, explain the difference in the direct write-off approach and the allowance approach, explain the items that change the allowance account, and report accounts receivable on the financial statements. Accounts receivable occurs when the company provides goods or services to a customer who agrees to pay at a later date. Hopefully, cash is subsequently received from the customer. In reality, every customer does not always pay, and an estimate of bad debt expense must be made and recorded in the same period as the sale to follow the matching principle. The allowance for uncollectible accounts reduces accounts receivables. Much later, when the company knows which customer will not pay and the exact amount, the accounts receivable is written off and removed from the list of customers who owe the company. The sale occurs and the customer is extended interest-free credit, usually for 30 days. Not all amounts will be collected due to disputes over the receipt of goods and services, pricing disputes, and a lack of cash or bankruptcy. More uncollectible accounts occur because of disputes than any other reason. Either the company or a collections agency will attempt to collect the past due accounts. Bad debt expense is the current period charge in the amount of accounts receivable that is not expected to be received from customers. Which customer will not pay is not known when the sale is made, or the company would not make the sale. The bad debt expense must be estimated in the period the sale occurs. It can take up to 2 years for a company to know the actual amount that will not be received from customers. There are two ways that are used to account for uncollectible accounts receivable. One follows GAAP and one does not follow GAAP. The direct method records bad debt expense in the period the account is deemed uncollectible for the amount the company knows will not be collected. The direct method does not follow the matching principle because the expense is not reported in the same period as the sale. The allowance method is in accordance with GAAP because the expense is reported in the same period as the sale. The actual amount is not known and it must be estimated. In this class, we will use the allowance method that is in accordance with GAAP. The allowance method reports accounts receivable net of the estimated amounts not expected to be collected. The net amount represents the probable future economic benefit to the company. This is the amount that is expected to be exchanged in cash for this asset. There is no economic benefit to uncollectible accounts. The allowance account is a contra asset account, which reduces accounts receivable on the balance sheet. Here is the current assets section of the balance sheet for Chipotle Mexican Grill. The company reports accounts receivable net of the allowance for uncollectible accounts. This is in accordance with generally accepted accounting principles. The net amount represents the probable future economic benefit, or the asset Chipotle expects to receive. The allowance method estimates and records the bad debt expense in the same period as the sale. Actual uncollectible amounts are written off in future periods when it becomes clear that a customer will not pay and they know how much will not be collected. An account is actually written off after several requests for payment are ignored, or a collection agency is unsuccessful. It could be that a bankruptcy notice is received, or also legal action is not successful. An actual write-off can occur up to 2 years after the sale. A write-off reduces accounts receivable and also reduces the allowance for uncollectible accounts. The changes in the two accounts result in no change to net accounts receivable at the time of the write-off. An expense is not recorded at the time of the write-off. The expense was recorded in the period of the sale when the amount was estimated, and the expense is not recorded twice. Let's look at an example of how a write-off affects reported net receivables. In this example, customers owe the company $100. The company estimates a total of $5 will not be received from customers. The company becomes aware that a specific customer will not pay $2, and that account is written off the detailed list of customers who owe the company. The amount of the write-off is removed from accounts receivable and removed from the allowance for uncollectible accounts. The net accounts receivable remains the same because both accounts change by the same amount. The change to the net occurred when the company estimated the bad debt expense and increased the allowance account. At the time of the write-off, accounts receivable net does not change. The write-off was accounted for and reported when the company estimated the $5 would not be collected. The allowance for uncollectible accounts will change by the amount of the current period estimate of the change in uncollectible amounts and will decrease with write-offs. Think of this account as a representation of amounts that won't be collected. However, the company does not know who or exactly how much. Once the company knows who and exactly how much, the account is taken out of the I don't know account and taken off the list of accounts receivable owed to the company. The ending balance represents the current estimate of total uncollectible accounts. Sales on credit, collections, and write-offs are recorded as they actually occur during the period. Bad debt expense is estimated and recorded at the end of the period in order to be reported in the same period as the sales. Recording bad debt expense always changes the allowance for uncollectible accounts. The allowance for uncollectible accounts and bad debt expense are estimated accounts that require a judgment. The current period estimate is also an adjustment of prior period estimates. The uncollectible amount is estimated and then accounts are written off. The balance in uncollectible accounts is the difference in the original estimate and the actual amount so far. The total estimated future amount changes with write-offs during the period and estimates in the current period. Always remember that reported amounts for bad debt expense and the allowance for uncollectible accounts are estimated amounts. A company does not go back and restate prior period financial statements when the estimated amount is different than what actually occurs. Inaccurate estimates are corrected in future periods and reported on future period financial statements. A company that underestimates bad debt must report additional bad debt expense in future periods to make up the difference. A lower bad debt expense is recorded in future periods when a company overestimates bad debt expense in prior periods. The estimate is continually re-estimated as time passes. After viewing this video, you should be able to describe the 4 transactions related to accounts receivable and explain the difference in the direct write-off approach and the allowance approach. You should be able to state the items that change the allowance account and describe how accounts receivable is reported on the financial statements. Please go to www.studymyaccounting.com and work through practices you learn for examples of the accounting procedures that are followed to record each of the concepts related to bad debt. Then work the practice test. Please route out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is very much appreciated.